Welcome to This Explainer. Today, we're diving straight into the absolute beating heart of global markets. We're talking about the single most powerful force in finance right now, and it's all centered around just one institution. The stakes, incredibly high. The atmosphere is tense, and honestly, the entire global economy is watching this closely. We're going to break down exactly what's happening, why it matters so much, and crucially, how it directly impacts your portfolio.
One decision from the Federal Reserve could impact your savings, stocks, Bitcoin, gold, and even the entire U.S. economy. Now, that's not some wild exaggeration. It is literally the mechanical reality of our financial system. The decisions made by a very select group of policymakers have a direct, measurable ripple effect right down to your personal wealth. Whether you're actively day trading, passively saving for retirement, or just managing everyday expenses, you are strapped into this macroeconomic roller coaster with the rest of us.
So you might be wondering, why the intense hyper-focus on the Federal Reserve all of a sudden? Well, it's because they control the foundational cost of money itself. When a Fed decision ahead warning flashes across financial terminals, it means the central bank of the United States is about to adjust, or hold steady, its target interest rates. These announcements carry immense weight because, think of it this way, interest rates act like gravity for the entire economy. Even a tiny tweak by the Fed dictates systemic liquidity. It alters how expensive it is for banks to borrow money, which then completely dictates the cost of capital for the whole system.
Section 1. The ripple effect and how rates impact assets.
You see, these macroeconomic decisions absolutely do not stay in D.C. They cascade outward instantly. Cheaper borrowing? That fuels corporate expansion, which typically drives stocks up. It impacts the housing market by directly dictating your mortgage rates. And fundamentally, it shifts the gravitational pull on inflation. Actually, that's exactly why the Fed pulls these levers in the first place. They're desperately trying to keep prices from spiraling out of control. For retail investors and the crypto enthusiasts tuning in, the focus really zeroes in on three specific asset classes: Bitcoin, gold, and stocks. These assets are incredibly sensitive to the Fed's levers. Stocks are traditionally tied to corporate earnings, right? And those fluctuate with borrowing costs. Gold, on the other hand, is historically viewed as your classic safe haven asset. So when confidence in fiat currency or the broader economy gets shaky, capital flows right into gold. And when the Fed makes money cheap, well, the liquidity tops swing wide open, and speculative assets like Bitcoin often see absolutely massive inflows.
Section 2. Markets on edge. The waiting game. Here's the thing about financial markets. They're fundamentally driven by future expectations. And right now, the future is pretty murky. Investors, day traders, institutional algorithms, everyone is waiting with bated breath. Every single time a Federal Reserve official speaks, their words are heavily scrutinized for any tiny hint or signal. Are they going to pivot? Will they stay the course? This waiting game creates a highly reactive environment. I mean, even a minor data point, like a monthly jobs report or a slight tick in consumer prices, can send markets swinging wildly as traders try to front-run whatever the Fed is going to announce.
Basically, right now, we're swimming in a state of deep uncertainty. Markets can price in good news, and they can even price in bad news, but they absolutely hate a vacuum. When the cost of capital in the near future is just one massive question mark, businesses delay hiring, consumers hold off on big purchases, and your portfolio essentially just hangs in the balance, trapped in this holding pattern.
And the underlying driver of all this market anxiety? It's the ongoing battle against inflation risk. The Fed isn't holding markets in suspense just for the fun of it. They're walking a very dangerous tightrope here. If they make borrowing money too cheap, inflation can just reignite, eating away at everyone's purchasing power. But if they make money too expensive for too long to crush that inflation, they risk triggering a severe recession, leading to job losses and a broader economic contraction.
Section 3. The if-then framework. Three possible scenarios.
Think of this as the ultimate if-then playbook for your portfolio. Let's break it down. If rates are cut, liquidity gets injected into the system. That's usually a giant green light for stocks and speculative assets like crypto as investors go hunting for yield. Okay, what if rates remain unchanged? Well, then we stay in this higher for longer holding pattern that pressures loans and flatlines the broader market as everyone waits for the next shoe to drop. But what if they're actually increased? The brakes are slammed. Growth assets take a direct hit as cash and bonds suddenly become highly attractive safe havens.
Right now, a tremendous amount of attention is focused on the possibility of a rate cut. It's for sure the most anticipated scenario for a lot of market participants who are just hoping for some relief. If the Fed officially signals that inflation is tamed and they can finally begin cutting rates, it could trigger a massive sigh of relief across financial markets.
It would signal a new era of cheaper money, lowering mortgage rates, and providing a much-needed fresh wave of capital for businesses to aggressively expand.
Section 4. Anticipating the signal.
So, what happens next? The entire financial world, from the highest Wall Street executives to everyday retail investors, is just waiting for that official press release and the big press conference from the Federal Reserve Chair. The very second that decision is announced, algorithms are going to execute thousands of trades in fractions of a millisecond, repricing the entire global economy based on the new reality of interest rates. The dominoes are all set up, and the Fed is just about to flick the first one.
Which brings us to the million-dollar question. If the Fed does cut rates, do you think stocks, Bitcoin, or gold will benefit the most? Really think about the mechanics we just explored together and exactly how capital flows when money gets cheaper. For more deep dives and rapid analyses on gold, Bitcoin, inflation, and global markets, make sure you're subscribed so you don't miss our next explainer. Thank you so much for learning with us today, and we'll see you next time.